Welcome. This is a short training on using sensitivity analysis in capital budgeting. The point is not to approve a long-term project off one set of numbers. We need to see what happens when the assumptions change, and we need a way to put that risk into the decision. Here is the flow for this training. Goal, functions, qualitative and quantitative steps, internal and external methods. The goal of financial management is to maximize the market value of the firm for the owners. Irons ties firm value to expected cash flow. An asset is worth the present value of the cash it is expected to produce. That is why we do capital budgeting. We are deciding which long-term projects get funded. If a project is riskier than average, we raise the discount rate. If it cannot beat the cost of capital, we should not fund it. Sensitivity analysis asks a follow-on question. Does that still hold if our assumptions are wrong? Financial management does four jobs. Investment decisions are capital budgeting. That is picking which projects get funded using tools like net present value, internal rate of return, and payback. Financing decisions are capital structure. That is how much debt versus equity we use and what that mix does to the weighted average cost of capital. Working capital decisions cover cash, inventory, receivables, and payables. Short-term cash still has to support the long-term plan. Risk and control is the last piece. We set hurdle rates, we run post audits, and we compare what actually happened to the estimates that were used to get the project approved. Qualitative work comes first. Carl Berg says you start a business case by reviewing the drivers of cost and benefits before you lock numbers to them. List the inputs, incremental sales, lost sales, cost of goods, advertising equipment, and the discount rate. Then separate what you can control from what you are guessing. Vendor quotes and labor contracts are usually tighter than a sales forecast. Also write down the benefits that are hard to put a dollar figure on. Faster cycle time, better quality, and flexibility still matter. Last, write the question the model has to answer. Which assumption, if we get it wrong, actually breaks the project? That is what you test next. Now the numbers. Build a base case with your best guess inputs, then change one driver at a time. That is the heart of sensitivity analysis. Carlberg's example is a loan rate. If the case assumes 9%, also run 8 and 10. Watch how profit, NPV, IRR, and payback move. Next, package those runs as named scenarios so leadership can compare best, base, and worst in one place. After that, use GoSeek when you need the break-even input. What sales volume keeps NPV at zero? Sensitivity analysis is not the same as expected monetary value. The week 4 transcript from Mao walks through both. Sensitivity shows how wide the range of outcomes is. EMV multiplies probability times dollar impact. Use both if you have decent probabilities. If you don't invent probabilities you don't have. Internal methods are the ones we control. First, use relevant cash flows only. Irons is clear on this. Capital budgeting uses cash, not accounting income, and only the extra cash the project creates. Working capital used to start the project is part of the investment and should come back at the end. Next, set the hurdle. Average risk work uses WACC. Higher risk work gets a higher discount rate, which lowers NPV. Then look at leverage. High fixed operating cost or a heavy debt load make profits swing more when sales miss. Run a post audit. Save the original estimates and compare them to what actually happened. Keep the qualitative screen. Quality, flexibility, cycle time, and obsolescence risk still belong in the decision, even when they are hard to quantify. External methods cover risk we do not control. CAPM is the course tool for that. Required return equals the risk-free rate plus beta times the market risk premium. Beta measures market risk you cannot diversify away. Interest rates are external too. Irons says the relevant cost of debt is the rate on the next issue, not the last coupon. Taxes can move after tax cash flows. Demand and competition sit outside the firm, which is why sales and lost sales are usually the weakest assumptions in Carl Berg's business case. Firms with few tangible assets take a bigger hit in a downturn, and lenders price that. Build the internal model, then test it with outside rates, demand, and required return. If the project only works in the best case, it is not ready. These are the sources behind the slides. This concludes the training.